There are many things to consider when allocating your capital, including active and passive investment strategies, both with their own benefits and risks. Joining me now to break it all down, we've got Roger Aliaga-Díaz, who is the Vanguard Global Head of Portfolio Construction. Great to have you here with us. So break this down for us, especially as we're considering some of these investing strategies. Where are you seeing investors lean towards right now as we are entering into the fourth quarter of 2024?
Well, investors usually try to weigh the benefits of active and passive based on kind of the expectation for the active managers. There is no really better environments for active. To be frank, I mean, each environment has its own challenges. Usually in election years or around Fed moves, those are periods in which perhaps some active managers can add value to the portfolios as opposed to investors trying to play those events in terms of asset allocation. So I would say in general, these are periods in which active management can add value definitely in the portfolio. The question is how much, right? How much of the portfolio into active management, how much in a strategic passive position.
What are the factors that investors should consider when making a decision in how to construct an active versus passive portfolio?
Yeah, look, traditionally, investors have always thought in terms of outperformance. Can active managers beat the market, outperform, right? And that has led traditionally to a more of a binary choice, all or nothing. If you think that your active manager is going to outperform, go 100% active. And if you're more of passive, like saying active managers cannot outperform, you go 100% passive. But what we propose in the Vanguard framework for active passive is more of a blend as you start thinking about the probability of outperformance as opposed to a certainty. So every manager may outperform on average, but in any 1 month may actually underperform, right? So there is more of a risk-return trade-off, like in the same way stocks and bonds. There is a risk-return trade-off. Your active manager gives you upside, but there is risk of underperformance, right? And then the other factor, in addition to the risk-return trade-off, is the risk tolerance of investors. We have to keep that in mind. There are investors that are more open and more patient, right, to tolerate periods of underperformance that comes with active management. So as you factor those things in a framework, you can come up with an optimal blend, right, like a best blend of active and passive in the portfolio, where you diversify the risk, but you still got some upside for that active management. And that blend does depend on each active manager, right? There is no one-size-fits-all solution, right? It depends on the profile of the active manager.
You know, we just came off of a month where we saw some new all-time highs for the markets. So what type of risk propensity are you seeing among active versus passive portfolio managers right now?
Yeah, no, definitely managers in the stock market, they're having a little bit more challenge, right? As a benchmarking against the equity market. I mean, there is only one play, right? Remember, active managers add value by selecting security and by betting securities in a different way than the market. And when all the market performance is driven from one sector in particular, it's kind of very difficult to bet against that, right? So you will see managers that are more diversified, that they are less concentrated. They have a place like wider bets in a market that is really rising. In a sideways market, you could see more active managers taking a little bit more risk. And fixed income space could be a little bit different because we are a little bit in a juncture. So that's where it could be more interesting to think about active management positioning.
Roger Aliaga-Díaz, who is the Vanguard Global Head of Portfolio Construction. Thanks so much for taking the time.
Great to be here. Thanks.